Welcome to Bill the Lender podcast, devoted to educating you on a variety of financial subjects with an emphasis on real estate and real estate finance. Please click the button to subscribe to my channel so you don't miss an episode. Then like and share your favorite episodes. Hey everybody, it's Bill Rodriguez and welcome to this week's installment of Bill the Lender podcast. I am Bill Rodriguez from Cornerstone Home Lending, Bill the Lender. And today I want to talk to you guys a little bit about the 5 areas of loan approval. Now, if you're a consumer, a first-time home buyer, a millennial, or anyone who's really wanting to understand underwriting and underwriting guidelines at a high level, this is for you. Also, if you're a realtor, maybe you're a newer realtor, and you guys are always spending a little bit of time in the grocery store, parties and barbecues because the weather's getting nice, meeting folks, and you're in a conversation and you may not know what to listen for, what to look for, what to ask for. This will give you some high-level guidelines for you to qualify your contact, your prospect, your client, potential client, and help you see if that's going to be a good use of your time in this intense and crazy market. Now, the 5 areas of loan approval: it's credit, it's income, it's job stability, it's assets, and it's collateral. But what I mean by collateral is the property itself, okay? Now, the 3 of those or 4 of those focus on the lendability or the credibility of the borrower. The last is the asset itself, because that is what the loan is secured against. So you're entering into an agreement between the lender and yourself, and the property itself is the collateral that you're going to loan against. So that's why it has its own sort of separate guidelines, approvals, and these types of things. Now, let's start with credit, because, and we're going to debunk some myths here because, it's really interesting. There's just a lot of stuff out there, but a lot of the millennial audience that I talk to, they really think still, for whatever reason, that you got to have a 740 or a 780 FICO score in order to buy a home. And really, what most people don't know is after 740, that's icing on the cake, okay? Now, for every 20 points that you go down, you're going to deal with a new tier, credit tier. So 640 to 720, 720 to 700, 700 to 680, and so on. All the way down for most lenders is a 620, which is most lenders' minimum FICO score. Cornerstone will go all the way down to a 580, which gives a little bit more flexibility for some of you. But the reality is that's going to determine, the FICO score really kind of determines the product that you're going to select as a consumer. And the reason that I say that is because there's 2 camps, 2 pillars, really 3 if you count jumbo loans, but 2 pillars where the majority of loans are done for the majority of consumers. And that's going to be government. That's going to be FHA and VA and USDA. And it's going to be conventional. Now, the government side of the house it's subsidized by the government. It has its own fund. It's called Ginnie Mae. They subsidize the mortgage insurance. You actually pay into the mortgage insurance pool. That's that upfront mortgage insurance premium when we get into some of the differences of this. And the pro of those types of programs is that, they don't penalize you as much for a lower FICO score. You can go all the way down to a 620 or a 640 and you're going to get the same rate as if you were a 740 on the conventional side. Now you'll have mortgage insurance and some of these other things that you can't get away from. Those are cons. That's another episode. But the long and the short of it is, in conventional, this is the private market, the private sector. So they grade, that's called risk-based pricing, on these different tiers. So for every tier you go down, you see an increase in your rate. You'll see an increase in the cost of your mortgage insurance. So past a certain credit score, say 700, 680, if you can go FHA, it makes more sense because you're going to get a cheaper payment. Now, this is a different market. There's a lot, again, to talk about. It's not this episode, but FHA is not stacked as high as conventional. So some folks may still choose to go conventional, and you work out a strategy to deal with that later if you can get your contract accepted, of course, right? But conventional really is the program type of choice, right? Then there is the basics on how to manage your FICO scores is something that I wanted to talk about under this piece. So credit is really scaled or figured out on its algorithm in a couple of different ways. There's the proportion of balances to available credit. So if you have a $5,000 credit card and you owe $4,790, you're going to start to see your credit take a ding on a monthly basis for the length of time that is over. Some people say 50. I like to say 30% threshold. Giving yourself a 30% threshold gives you a little bit of wiggle room in case the car breaks down and you don't have the liquid cash. You got to fix the car because you got to get to work. It gives you a little bit of a buffer. Okay. The other piece is the available credit. That's the balances to available credit, the types of credit. So that would be student loans, revolving debt, which would be credit cards, car loans, and house loans. Those are all ranked differently. Student debt, because it's federal debt, is ranked equally with a mortgage loan. So you can't default on either one of those, okay? Because it's a big slide to your score. Now, the other piece of that is the length of time, because that is, credit. If you think of credit as the ability to show creditors that you can make payments on time. And so the longer period of time that you have for those trade lines and it's good history, the higher your score will be over time. That also means that if you have a mistake or you have some anomalous thing in your life that you get into trouble financially, over time, that will also improve. So it's designed to be forgiving. The last piece is the amount of credit that you have. So it's the type, and then you need a minimum of 3 to 5 trade lines. And by trade lines, that's going to be the aforementioned credit cards, student loans, car loans, these types of things. 3 to 5 trade lines. If you haven't bought a house yet, that's okay, because you can still have a great score without owning a home. If you have, 3 to 5 credit cards and a car loan, that should be adequate credit to score you. Now, will you be over 740? Maybe. It all depends. Everybody's situation is a little bit different. You have a higher likelihood of having a higher score the longer those trade lines are open. Okay. Now, let's talk about income. Income is one of those things that, there are a lot of different guidance out there in terms of approvals. Some people say 2335. What that refers to as a front end and a back end ratio, or debt to income, is not to exceed, your monthly obligation shouldn't exceed 23% of your gross monthly. And 35 is your current debt load, that that all of the obligations that are recorded on your credit plus the new house payment shouldn't exceed over 35%. Um, if you've ever bought in a home or before, you'll hear 35 and 43, which is the more recognized one, and some programs like FHA with automated underwriting approval will allow you to go up to 50 or over. Conventional loans will not allow you to go over 50. So always recognize too that as a lender, we're going to qualify you off of the gross monthly, not your net. Though we both know that Uncle Sam exists to take your money, the reality is that you may be surprised by how much you can qualify for, because we're going to take that gross monthly payment. That's before the taxes are taken. Now, as far as some of the changes that we saw from COVID, uh, variable income, which means you work a part-time job, and for part-time income to count, by the way, you need to have it with your concurrent job for 2 years or 24 months. And if that varies at all, meaning that maybe you lost your job due to COVID, and now you've picked up a waitressing job, and you've done that for less than 12 months, and the hours fluctuate. If those hours fluctuate, I need a minimum of 12 months to average that income if it's considered variable. Any variance in the hours, it can be a problem. If you're working concurrently part-time on another job and you have the 2 years, we're going to average the hours and the income over those 2 years. And then there's the self-employed, which I always get a ton of questions on. W-2, if there's a preference, first of all, as a lender, I never have a preference of the type of clients. And just because you're self-employed doesn't mean that necessarily that you won't get a loan. The misnomer there is that as the owner of a business, you have the option to write off all the expenses against any profit or income that you make. And most CPAs they think oppositely of a lender. A lender is there to squeeze every dime out of what you make to get you to qualify for where you're trying to go and what you're trying to do. A CPA is trying to help you hide every cent that they can from the IRS. And those two things operate, incongruent with one another, in opposition to one another. So it makes sense for you to have your mortgage professional, and we do this all the time, help the CPA understand from an underwriting perspective how much income that you need to get where you need to go. And then he can adjust your expenses from there. I've seen people make $150,000 and their gross adjusted, meaning the line item, what they take home on paper after the expense of the business, is like $30,000, and they want to buy a $450,000 home, and that just doesn't work. And so that's the misnomer around the self-employed. What it actually just takes is a little bit more proactiveness to getting with your trusted mortgage professional to give you some of that guidance. We do a lot of consultations around April and October, around this time, for the self-employed, whether they're filing their taxes in January or they're dealing with the extension in October. We're saying, okay, hey, this is how much you need. This is, I see how much expense you have, is some of that, can that be moved? And we work with the CPA to help them sort of understand, and maximize. We don't need to show everything. We only need to show enough so that, you only have to pay what you need to Uncle Sam, and we can get you into the house that you want to be in. Okay. So the types of income that can be used. So we talked about self-employed. That's K-1, 1099, these types of things, whether that's an S corp or corporation, might be a W-2 in there as well. So W-2, straight W-2, you're an employee. Inside of that, there's overtime, there's bonus income, there's, and if we need, or sales, maybe you're in sales. If any one of those categories is over 25%, we're going to probably want to see a tax return as well, just to average that over time. But all of those types of income work. But there's also trust income. There's also investment income. There's a ton of other things, maybe real estate. You're making passive earnings from the rentals that you own on your Schedule E. All of that can be used. We're going to take but we're going to take the return and we're going to go through it line by line. And it may be a little bit more complicated, but we can help you do that. Now, the biggest caveat is any income that you have has to be in existence for a minimum of 3 years to use it. So you might be going through a divorce and you're a mother that's returning to the workforce and you've negotiated a settlement with your ex and they're going to pay you alimony and child support to help you get back on your feet as you enter back into the workforce. Well, to use the alimony and the child support, I need to support that you're receiving those payments for a minimum of 6 months. Then we can start using the income, right? And then in that 6-month period, if you're returning to the workforce, especially if it's in a new line of work, let's say you've gone to school, then you had children, and you've been a stay-at-home mom all that time, and as you're entering the workforce, the only job that you could find wasn't in your field of study. You're a nurse or you're a physical trainer, or it's something outside of what you were doing. You need to be on the job for 6 months as well. Okay. So anytime you're going major changes in your income, meaning, I'm working for an employer 3 years, then I go to W-2, or I'm W-2'd, then I go to 1099 because they're trying to save some money on taxes and overhead on insurance and so what have you. And now I'm a 1099 employee. Well, technically I'm self-employed, right? So now I need at least a minimum for us, 16 to 18 months. You don't necessarily need the 2 years tax returns, but 10 to 12 months on a tax return plus current year-to-date P&L. So that may delay you. So the quick answer, because this is a big one that snags people a lot, if you have any major changes coming, best to discuss them with your financial professional, myself, somebody on my team, or, right, make those moves prior to the change happening, right? So that could escalate your timeline or push it back, as the case may be, right? Okay, now job stability. Job stability, we got a little bit into this with variable income. Job stability just means that if you, like, as an example, and most people don't know this, you come out of college, you're entering the workforce for the first time. You don't have that 6 months, but you want to buy a home. Well, the good news is that if it's in the field of study, all of that schooling counts towards your job history, which is awesome, right? So again, we talked about any sort of income has to continue or is likely to continue. So, if we're not looking for folks who are bouncing around on the job, and if they are, it's to a similar field. If you're changing field, then we're looking for you to explain what skills that you took from one job to get you your next. And then we can bridge that gap. Even if it's a different field, you may have learned something from, working as an employee of a company, and you say, you know what, this is a really cool niche. And you're moonlighting as a marketer. All of a sudden now you want to take over marketing to that company. It might be a stretch, but I understand this industry, and here's my experience, and here's my certification on the marketing side. I got this experience and developed this niche, and I'm earning income now as a marketer to this industry of business. we might be able to build a case to make that work. There are a ton of specific situations, we get them a lot, where folks have picked up a skill that was transferable to the next. So the next career is in a similar field, but it's not the same. And they're concerned. They're concerned that that's not going to be the job stability that they need, and they're not going to be able to use the income. As long as we can build a convincing case, we can do it. Okay. We talked about changing from W-2 to 1099. And then job gaps is another big one. Certainly with COVID, we saw, furloughs and these types of things. If you have any job gap larger than 3 months, then, there's a high probability or likelihood that you going to have to be on that job for 6 months before we can count the income again. Okay. So any job gap larger than 3 months, you're probably going to have to wait 9 months. Okay. Thanks for listening to Bill the Lender podcast. Please reach out to me with any questions at 303-877-6323.